I'm JD Frost. Welcome to the Accountability Show. Thank you for tuning in. I hope that you're enjoying these episodes and that you're learning something every single time you're watching these videos. I'm trying to keep them short, sweet, to the point, give you as many examples as possible. And what else is pretty cool is in each episode, we're talking about specific points of these items that are building the accounting foundation in your business. So we talk about the what, we talk about the why, we talk about the how. And today we're talking about how do you create a cash flow statement. Next episode, we're going to have a special guest on here where we're going to be discussing cash flow statements with them in their business. We're going to get some real life information, some real life examples of, do I even care about a cash flow statement? Did I even know about it? Can you tell me more about how that applies to my business? Those are the kind of things that we're going to be answering in the fourth episode related to this specific topic. So, how do you create a cash flow statement? The cash flow statement is a statement that allows you to understand how cash flows through your business. How does cash come into your business? How does cash go out of your business? And there are three different areas that the indirect method allows you to identify how cash is moving through your business. So the cash flow statement has two different methods that you can create it. There is the direct method and there is the indirect method. The indirect method is a GAAP basis method. GAAP stands for Generally Accepted Accounting Principles. So we start with net income when you're starting with the indirect method of a cash flow statement. Your net income or your net loss. You write that number down at the top. Now, there are three separate sections in the indirect method of the cash flow statement. There's operating activities, there is investing activities, and there is financing activities. And the key thing when you're talking about cash flow is the difference between one balance sheet period and another balance sheet period. So, for instance, when you have a balance sheet that ends at the end of 2019, and then you have a balance sheet that ends at the end of 2020, the difference between those numbers on that balance sheet for all those different accounts is the number that you want to put on the cash flow statement. Now, this is going to get super technical, so I hope you're able to follow along with me. If not, please comment below any questions or anything that you might have, because I would love to answer those questions for you later. So, operating activities, assets. If you have an accounts receivable that is $100,000 at the beginning of the year and $200,000 at the end of the year, that increased $100,000. If you have an asset that increases in the operating activities on a cash flow statement using the indirect method, if the asset increases, that means your cash decreased. Asset increases, cash decreases in operating activities. Now, if you have an asset accounts receivable that is $100,000 and it goes down to $50,000, as your asset decreases, your cash increases. So it's an indirect relationship. Now, let's take inventory. Inventory is an asset. That's another operating activity in your balance sheet. So inventory goes from $100,000 to $200,000. Well, how did that inventory increase from $100,000 to $200,000? You paid somebody for that inventory. You spent money on cost of goods sold. Not cost of goods sold, on inventory. You spent money on materials. You spent money on labor to create that manufactured item. Work in progress is another example of inventory. If your work in progress went from $100,000 to $200,000, or your inventory did, that would be an increase in an asset, which means what? A decrease in cash. Now, liabilities. That's another type of operating activity. Liabilities, like accounts payable, accrued liabilities, payroll liabilities. If a liability increases, cash increases. So it's a direct relationship. Assets have an indirect relationship with cash. Liabilities have a direct relationship with cash in the operating activities section. Okay? So if you have an accounts payable that went from $100,000 to $200,000, That would be an increase of $100,000 in that liability. If you did not pay that liability, that means you had an increase in cash. You kept your cash. If your payroll liabilities went from $100,000 down to $50,000, then you had a decrease in liabilities. In order to decrease liabilities, that means that you paid somebody for that liability. You paid them a debt. You used your cash. So that decreased your cash. So liabilities, if you have a decrease in liabilities from the balance sheet period here to the balance sheet period here, that means you had a decrease in cash. If you had an increase from the liability balance to another balance in this period, that's an increase in cash. Those are operating activities, assets and liabilities on your balance sheet, current assets, current liabilities. That is a balance sheet item. Those are the operating activities on your cash flow statement. Is this making sense? So, your operating activities, at the very bottom of that section, it's going to say cash used in operating activities or cash gained in operating activities. So all those numbers added up, the differences between the balances, that's a number. All those numbers add up will determine whether you have a positive cash flow from operating activities or a negative cash flow from operating activities. The second section is investing activities. Investing activities typically, there's so many exceptions to every rule. So anything you hear on these accountability shows, there's an exception for it, no matter what. I should have said that in the first 18 episodes every single time. Everything I'm saying here has an exception. That's why the number one answer for any accounting question is it depends. Because it does. It depends. But in general, investing activities involve long-term assets. So on your balance sheet, you've got current assets. You got non-current assets, which is basically a long-term asset. You have current liabilities. You have long-term liabilities, and then you have equity. In the investing activities section of your cash flow statement, it typically only involves the long-term assets. Did you purchase a piece of land? Did you purchase an investment that's going to be longer than 1 year? Did you purchase equipment? Did you sell equipment? Did you sell a piece of land? Did you sell an investment? That's what's going to happen in the investing activities. Now, if you purchased a piece of property, that would be an increase in a long-term asset. When you increase an asset, what does that do to cash? In the investing activities, it doesn't necessarily always decrease cash. Doesn't necessarily always do that. But in general, if you invest in a piece of land and you paid cash for it, that would decrease cash. If you sold a piece of land and you got cash for it, that would increase cash. So investing activities, long-term assets, those balances between a period of a balance sheet and another period of a balance sheet, that's going to be what's in your investing activities. Third section, how do you create a cash flow statement? The third section is financing activities. Financing activities involve long-term debt and equity. So when you get a line of credit and you draw off that line of credit goes from zero and you pull $100,000 off that line of credit. That $100,000 went into your bank account. That's an increase in cash. So an increase in a long-term liability, increase in cash. If you paid down that line of credit from $100,000 down to zero, you used cash to pay it down. That decrease in that long-term liability is a financing activity, and that's a use of cash. You use the money to pay down that liability. If you paid yourself a distribution in your business, that's a distribution of equity. You had to use cash to pay yourself. That's a financing activity. If you contributed money to your business, if you increased your contributions, that increases your cash. That's money coming into your business. That's a financing activity. Those are the most generic financing activities that you'll find in your business. So how do you build a cash flow statement? You need your balance sheet from a prior period. You need your balance sheet from your current period. You need your income statement from your current period, because the net income or the net loss is your starting point. That's the start line. The finish line is your ending cash balance. Now, in between there, we have operating activities, investing activities, financing activities. Then next is your beginning cash number. What did you start with? That is the balance sheet cash number on your beginning balance sheet. That's your starting point for your beginning cash. Now, your ending point is your ending cash, and that needs to equate to the amount of cash that you have on your balance sheet on your current period balance sheet. Now, that might sound like a whole bunch of jargon and shit that you really have no idea what I just said. And that's okay. Go back and rewatch this episode. This one involves a lot of technical parts of the cash flow, because we're talking about how do you generate one? How do you create a cash flow statement? This is where you start. You got to have these ingredients: balance sheet beginning period, balance sheet ending period, income statement current period. And then you have to determine the change in these activities: operating, financing, investing, in order to know where your cash went, so that you can determine whether the beginning cash number changed and you arrived at the ending cash number. That's it for this episode. That's all I can tell you about how to create a cash flow statement. If you have any other comments or you have any other questions, please put them below. Turn on the notifications. And also, for those listening to the Accountability Show on my podcast, subscribe to this channel. I'm going to be dropping episodes each week. These are going to be from my speeches, from other shows that I have, from the Accountability Show for sure, and from interviews that I have on different webinars that I'm having with Tim Story, Hank Norman, Michael Burt, Cody Kearns. We have a lot of content on the podcast, and I'd love for you to go there. Spotify, iTunes, go subscribe to the podcast so that you know when a new episode drops, so that you can listen to that as well. I hope you are having an awesome day. Thank you for tuning in to the Accountability Show, and stay tuned for the next episode when we're interviewing a special guest about how they use their cash flow statement in their business.